Trade like a stock market wizard. How to achieve super performance in stocks in any market by Mark Minervini. Lean in for a moment. I want to tell you about a peculiar kind of alchemy. Not the medieval kind where people tried turning lead into gold, but something that actually works. This is about transforming a modest stake into genuine wealth through understanding the rhythm and heartbeat of the stock market. Sounds almost too good to be true, right? Especially when you hear Mark Minervini's story. Picture this. A 15-year-old kid walks away from school. No diploma ever crosses his hands. No college acceptance letter arrives in the mail. He's essentially teaching himself everything from scratch. He begins with just a few $1,000s and a burning ambition. Then comes 6 brutal years of stumbling, losing money, tasting failure, so often it becomes familiar. Most people would have walked away. Most did walk away. But Mark? Something fierce burned inside him, an unshakable determination, a crystal-clear vision. He wasn't interested in just trading stocks. He was after what he calls super performance, the kind of returns that sound fictional until you see the numbers yourself. And the numbers? They're staggering. By 34, starting from nearly nothing, he'd become a multimillionaire purely through stock trading. In 1997, he won the prestigious U.S. Investing Championship, crushing the competition with a jaw-dropping 155% return in just 1 year. Over 5 years, his average annual return hit an almost unbelievable 220%. Let that sink in. That's turning $100,000 into over $30 million. So how did he do it? Was it dumb luck? Inside information? Some inherited secret? None of the above, Mark insists. It was strategy married to discipline. It was thousands of hours staring at charts until dawn broke, devouring over 1,000 investment books, celebrating his wins, but, more critically, dissecting every loss with surgical precision. He crafted a specific methodology, a blueprint extracted from studying history's greatest stock market champions, identifying what they all had in common before their monster moves. He named it SEPA, Specific Entry Point Analysis. His book, Trade Like a Stock Market Wizard, isn't another generic investment guide gathering dust on shelves. It's the concentrated essence of decades of work, a generous sharing of the exact principles that carried him from high school dropout to market legend. It's become essential reading for serious traders, with countless copies sold and an entire generation inspired to reach for super performance. Today, we're stepping into Mark's universe. We'll dig into the mindset, the strategy, the unwavering discipline he considers essential, not merely to survive, but to genuinely thrive in the market. By the time we're done, you'll grasp the fundamentals of his SEPA strategy, how to spot potentially explosive stocks, the precise moments to buy them, and, perhaps most importantly, when to sell to protect the capital you've worked hard to accumulate. This isn't some get-rich-quick fantasy. It's about learning a genuine craft, mastering a skill that, once internalized, can serve you throughout your lifetime. Ready to dive in? Let's decode what the wizard knows. So where does this journey toward becoming a stock market wizard actually begin? Mark Minervini is crystal clear. It doesn't start with fancy charts or mysterious formulas. It starts right between your ears, inside your own mind. He draws parallels to champions across all domains, whether it's Muhammad Ali in the boxing ring or elite marathon runners, and notes how they win not purely through physical prowess, but through something deeper: desire, vision, an unshakable dream. The stock market operates the same way, he argues. He's living proof. Leaving school at 15 meant he was almost entirely self-taught. Forget college. He never even graduated high school. Yet he possessed this insatiable hunger to succeed, a ravenous appetite for market knowledge that drove him through more than 1,000 books, studying history, psychology, and the patterns of legendary winners. Doubters surrounded him, voices insisting it was impossible, rigged, too dangerous. His message rings clear. Ignore them. People declaring something can't be done are usually just broadcasting their own limitations and inexperience. Money wasn't his only motivator. He craved freedom. the freedom to do what he loved, when he wanted, wherever he chose. The stock market appeared to him as the ultimate playing field for this dream, a realm of unlimited potential, without prejudice or gatekeepers. But success played hard to get. 6 long years passed without profit, only net losses mounting. What kept him grinding forward? Unconditional persistence. He emphasizes that commitment, that refusal to quit when everything feels wrong, matters infinitely more than starting knowledge. Knowledge grows with study, skill develops with practice, but greatness never finds those who surrender. Years melted away as he refined his approach, frequently working 70 to 80 hours weekly, dissecting both triumphs and, crucially, disasters. Then lightning struck when opportunity finally met preparation. As a fresh bull market ignited in the 1990s, he stood ready, armed with lessons carved from trial and painful error. He stresses that opportunities appear suddenly, and you absolutely must be prepared to seize them. Prepare relentlessly, because when opportunity taps on your door, you need to be standing there ready to answer. This skill, once forged through real experience, becomes permanently yours. No boss can strip it away. It's just you facing the market. But genuine passion is required. The finest traders, he notes, get genuinely excited about the game itself, energized by the challenge, rather than merely chasing money. Focus on becoming the absolute best trader you can be, and money naturally follows. When should you start? This very moment. Don't wait for someone's permission. Better to do something imperfectly than to do nothing flawlessly. Take action. Now let's shatter some common myths Mark wants demolished immediately. First, you don't need mountains of money to begin. He calls this belief complete nonsense, pointing to his own beginning with just a few $1,000s. He shares how a friend actually quit trading because someone convinced him his starting capital was too small. Mark insists you can start small and grow from there, just like Michael Dell launched his computer empire from a dorm room with $1,000. Many successful traders started tiny. What united them was refusing to believe it couldn't be done. Another persistent myth: it's different this time. Mark's heard this chant in every single market cycle for 30 years. He quotes the legendary Jesse Livermore, "Wall Street never changes, because human nature never changes." Greed, fear, ignorance, hope. These emotional drivers propel markets today exactly as they did a century ago. History repeats itself with remarkable consistency. Here's a crucial insight. Your greatest obstacle isn't the market. It's staring back at you from the mirror. No system or brilliant strategy can overcome fundamentally flawed psychology. Mastering your emotions becomes paramount. This connects to another truth. Nobody else will do this work for you. Mark learned this brutally early when a broker obliterated his account, pushing some speculative biotech stock. From that expensive lesson, he vowed to conduct his own research and make his own decisions. Relying on tips or so-called experts is essentially throwing darts blindfolded. Do the work yourself, own your failures completely, and you'll own your successes too. Perhaps the biggest psychological monster? Your own ego. Mark poses a cutting question. Do you want to be right, or do you want to make money? He recalls how early on, the fear of embarrassment from a broker friend sometimes paralyzed him from selling losing positions. A stock would tumble 5%, then 10%, and he knew he should bail out. But the prospect of admitting error, of enduring the teasing, made him hold on while losses compounded. His performance completely transformed only when he decided making money mattered infinitely more than proving his intelligence. He started slashing losses quickly, accepting small hits but preserving precious capital. This mental liberation allowed him to analyze losers objectively, rather than trying to forget they ever happened. The lesson cuts deep. Separate your trading completely from your ego. He also challenges the notion that simply practicing trading makes you better. Practice doesn't create perfection. It only creates habit. If you're practicing the wrong approaches, you're just cementing bad habits deeper. This explains why he dislikes paper trading, practicing without real money at stake. It doesn't prepare you for the emotional pressure of having actual capital on the line. It's like shadowboxing without ever stepping into an actual ring with a real opponent. He recommends starting with real money, even if it's a small amount, as quickly as possible to gain authentic experience. Treat trading like a legitimate business, not a weekend hobby, because hobbies drain money while businesses generate it. And critically, don't attempt to invest like massive fund managers. Individual investors possess significant advantages. Big funds get trapped by their own size. Needing liquidity forces them into large-cap stocks, committee decisions slow them down, and pressure to stay diversified and benchmarked constrains their choices. As an individual, you can be nimble, concentrate capital in your absolute best ideas, and use stop losses effectively without moving the entire market. You can strike quickly and wait patiently for the absolute perfect moments. Want mutual fund results? Then invest like a fund manager. Want super performance? You need a radically different approach. Conventional wisdom produces exactly that: conventional results. To achieve something exceptional, you must embrace the unconventional. Reaching this level demands sacrifice and laser focus. You can't simultaneously be the best value trader, growth trader, day trader, and long-term investor. Like a doctor choosing to specialize in surgery or pediatrics, you must define your style and specialize within it. Are you a short-term trader comfortable grabbing quick profits, even if the stock doubles afterward? Or a longer-term investor willing to weather fluctuations for a substantially bigger move? Define your approach clearly, commit to it, and accept that it won't work perfectly in every single market cycle. Expect setbacks, disappointments, brutal days. They're simply part of the process. Learn from them, but never let them make you quit. So if conventional wisdom isn't the path forward, what is? Mark's journey led him to develop his own methodology, SEPA, which stands for Specific Entry Point Analysis. This wasn't invented in a vacuum. He built upon the shoulders of giants, studying market masters like Richard Love, who researched super performance stocks, Mark Minervini, who analyzed stock market champions, Robert Levy on relative strength, Edward Jensen on stock blueprints, Richard Donchian on trend following, William Giller on chart patterns, and the legendary Jesse Livermore. He synthesized their collective wisdom with his own decades of experience and quantitative analysis, particularly empowered by personal computers arriving in the late 1980s. SEPA's core concept is elegantly simple, yet profoundly powerful. Study the best to discover the best. Mark meticulously analyzed the shared traits of stocks that achieved super performance before they made their colossal gains. He discovered recurring patterns, what he calls a leadership profile. SEPA aims to identify stocks fitting this profile and pinpoint the precise moment to enter, where potential reward massively outweighs risk. It combines fundamental analysis, understanding what the company does, with technical analysis, observing how the stock behaves. SEPA stands on 5 key pillars. 1. Trend. Super performance happens when a stock rides a clear uptrend. You want the wind pushing at your back. 2. Fundamentals. Big moves typically get fueled by improving earnings, accelerating sales, and expanding profit margins. The numbers need to support the narrative. 3. Catalyst. There's almost always something exciting unfolding. A breakthrough product, FDA approval, dynamic new CEO, emerging industry trend that attracts attention and institutional capital. Think Apple's iPhone or Google's search dominance. 4. Entry points. Even the finest stocks need to be purchased at the optimal moment, typically emerging from a consolidation period, offering a low-risk entry. Timing isn't everything, but it's crucial. 5. Exit points. Not every trade works perfectly. You absolutely must have predetermined points to cut losses, stop losses, and points to capture profits. Mark employs a rigorous screening process built on these elements. First, a stock must satisfy his trend template criteria. We'll explore this more. Then it's filtered for robust earnings, strong sales, and superior relative strength. Finally, He scrutinizes remaining candidates against his leadership profile, hunting for similarities to historical winners. The goal? Finding stocks with potential for future earnings surprises and significant buying demand from major institutions. He seeks what he calls a probability convergence, where all factors align beautifully. What does this leadership profile actually look like? Mark discovered most superperformers are relatively young companies, frequently within 10 years of their initial public offering. This doesn't mean they're brand new startups. Many were thriving private companies first. Think Microsoft, Home Depot, Dell, Cisco. They were relatively unknown when they began their legendary runs. Don't automatically avoid names you've never heard of. Size matters too. Explosive growth usually happens when companies remain smaller and more nimble. Small-cap or mid-cap stocks generally possess more potential to appreciate rapidly than large, mature behemoths. It requires less buying demand to move a stock with fewer shares floating around. Now let's tackle a big one: value. Mark argues that traditional notions of value, especially the price-to-earnings ratio, are often misunderstood and largely useless for discovering superperformers. The standard P/E ratio looks backward at past earnings, while the market constantly looks forward. Relying on future estimates for a forward P/E is treacherous because estimates are frequently wrong. He warns strongly against bottom fishing, buying stocks that have crashed simply because their P/E looks historically cheap. Often, that price collapse anticipates forthcoming bad news. He points to examples like Morgan Stanley, AIG, Citigroup, and Bank of America hitting decade-low P/E ratios in 2007, 2008, right before plunging 90% or more. Buying cheap stocks solely because they appear cheap is a dangerous trap. If they get cheaper still, your original rationale tempts you to hold on or buy even more, digging a deeper hole. Conversely, don't automatically dismiss stocks sporting high P/E ratios. Fast-growing companies frequently trade at premium multiples, sometimes 3 or 4 times the market average. Many of history's biggest winners traded at P/E ratios of 30, 40, or astronomically higher before their largest advances. Yahoo, for instance, traded at over 900 times earnings when Mark bought it in 1997. It then rocketed 700–800% as its P/E expanded even further to 1,700 times earnings. Taser traded at over 200 times earnings before a 300% surge. The truly exciting companies don't sit in the bargain bin. They often appear expensive, which is precisely why most investors miss them entirely. Wall Street struggles mightily to value companies growing at explosive rates. Stocks can reach seemingly absurd valuations and continue climbing. Value doesn't move stock prices. People do, through their perceptions and buy orders. Demand is what ultimately matters. Thinking a stock is overvalued at 65 times earnings is like claiming a Van Gogh painting is overvalued because the canvas and paint only cost $40. Perceived value, driven by demand, sets the actual price. Mark suggests viewing the P/E ratio simply as a barometer of market sentiment or expectation. High P/E signals high expectations. Low P/E signals low expectations. Focus instead on the potential trajectory of earnings growth. A genuine market leader often represents better value despite a higher P/E. He does offer one warning. Be extremely reluctant to buy stocks with excessively low P/E ratios, like 3, 4, or 5 times earnings, especially if they're languishing near 52-week lows, as this often signals deep fundamental problems or even looming bankruptcy. He also cautions against the broken leader syndrome. Investors who ignored a stock during its meteoric rise suddenly get interested after it's peaked and tumbled significantly, thinking it's now a bargain. Often, that fall is discounting a future slowdown, making it no bargain whatsoever. Sun Microsystems serves as a prime example, falling 75% from its high in 2001, tempting bargain hunters, only to fall another 80% afterward. So if PE isn't the key metric, what fundamental factors should capture our attention? Earnings, earnings, earnings. How much can a company realistically earn? For how long? And how certain is it? Profitability, sustainability, and visibility are crucial. Why? Because massive institutional investors, mutual funds, hedge funds, actually drive stock prices, and they focus intensely on earnings. They particularly love earnings surprises when a company reports results better than analysts expected. A positive surprise forces analysts to revise their future estimates upward, making the stock appear more attractive and triggering waves of institutional buying. This effect isn't instant. Studies reveal a post-earnings drift, where stocks tend to continue moving in the direction of the surprise for months afterward. Hunt for companies consistently beating estimates, especially by significant margins. Beware tiny beats, just a penny or two, as companies often manage expectations downward to achieve these easily. Look for upward revisions of estimates, especially by 5% or more. Even better than just surprises is earnings acceleration. This means the rate of earnings growth is increasing quarter after quarter. For example, up 10%, then 28%, then 56%. Over 90% of the biggest historical winners showed earnings acceleration before or during their major price moves. Crucially, earnings growth should be supported by strong revenue growth. You want to see accelerating sales alongside accelerating earnings. This indicates genuine business momentum, not just accounting sleight of hand or temporary cost-cutting. Mark highlights Netflix during 2009-2010 and Home Depot during 1982-1983 as examples where accelerating sales fueled massive stock gains. Check the trend over several quarters. Ideally, you want steady improvement building. Look at annual earnings, too. Strong quarterly results should translate into strong annual growth. Sometimes you can spot a breakout year where current earnings surge above a multi-year range. When assessing earnings quality, ask where the earnings actually came from. Are they from core business operations or a one-time windfall like selling assets? Exclude non-recurring income. Be wary of massage numbers, where companies guide estimates down only to beat the artificially lowered bar or repeatedly claim one-time charges. Watch for inventory write-downs or suspicious shifting of revenues between periods. Be especially cautious if profitability derives mainly from cost-cutting measures, layoffs, plant closures. While temporarily helpful, sustainable growth demands revenue growth. The ideal situation? Accelerating sales and expanding profit margins happening simultaneously, what Mark calls a Code 33. 3 consecutive quarters of acceleration in earnings, sales, and margins. This combination is genuinely explosive. Monitor margins closely, both gross and net. Expanding margins indicate pricing power or efficiency gains. Also pay close attention to inventories and accounts receivable, especially for manufacturers and retailers. Are inventories, particularly finished goods, growing much faster than sales? This can signal slowing demand and future painful markdowns. Are receivables, money owed by customers, climbing much faster than sales? This could indicate trouble collecting payments. Both rising together is a major red flag waving. Ultimately, the market's reaction to an earnings report tells the real story. Did the stock rally powerfully on good news and hold those gains? Did it shrug off a beat or even sell off despite positive results? This reveals true investor perception beyond the numbers. Also listen carefully to company guidance, forward-looking statements, especially for the upcoming quarter and year. Positive guidance accompanying strong earnings creates a powerful combination. Now let's tie this back to the trend. Mark insists that superperformance almost always happens when a stock rides a confirmed uptrend. He developed a concept called stage analysis, popularized by Stan Weinstein, which views a stock's life cycle in 4 distinct stages. Stage 1: neglect/consolidation. The stock price drifts sideways, oscillating around its 200-day moving average with no real trend. Volume is often light. Avoid buying here. It's dead money going nowhere. Stage 2 advancing/accumulation. This is where superperformance occurs. The stock breaks out of Stage 1, making higher highs and higher lows. The 200-day moving average turns upward. Volume surges on up days and weeks, contracting on pullbacks. Clear signs of institutional accumulation. This is the only stage Mark wants to be buying in. Stage 3 topping/distribution. Momentum slows noticeably, price action becomes more volatile and erratic. Big down days or weeks on heavy volume start appearing. The 200-day moving average flattens or rolls over. Smart money is quietly selling to weaker hands. Stage 4 declining/capitulation. The stock is in a clear, painful downtrend, trading below its declining 200-day moving average, making lower lows and lower highs. Earnings often disappoint repeatedly. Avoid buying here at absolutely all costs. To objectively identify Stage 2, Mark uses his trend template, a checklist of 8 specific technical criteria. These include the stock price being above key moving averages like the 50-day, 150-day, and 200-day. The moving averages themselves trending correctly, for example, the 150-day above the 200-day. The 200-day trending upward, the price being significantly above its 52-week low but close to its 52-week high, and a strong relative strength ranking. A stock must meet all criteria to qualify. This acts as a strict initial filter, immediately eliminating weak candidates. Even within a Stage 2 uptrend, stocks don't shoot straight up. They move in waves, pausing to consolidate gains before the next advance. These consolidation periods, or bases, are crucial because they offer potential low-risk entry points. Identifying a proper constructive base is absolutely key. This brings us to perhaps the most important technical concept in Mark's entire toolkit, the volatility contraction pattern, or VCP. He observed that virtually all constructive bases, where institutions are quietly absorbing shares, show a distinct pattern. Volatility systematically decreases from the left side of the base to the right side. Imagine a stock pulls back 25% from its high. That's the first contraction. Then it rallies a bit and pulls back 15%. Second contraction. Then another rally and an 8% pullback. Third contraction. Each successive pullback gets shallower, tighter. Critically, these contractions are accompanied by significantly drying up volume, especially during the tightest areas on the far right side. This tightening price action combined with diminishing volume signals that sellers are disappearing. The stock is coiling like a compressed spring. Mark uses a shorthand footprint to describe these patterns. For example, 10W18/52T means a 10-week base, correcting 18% initially, tightening to 5% with 2 total contractions. This VCP process establishes the line of least resistance. The precise spot where the stock tightens up just before breaking out is called the pivot point, the optimal buy point. You buy as the stock moves above this pivot point, ideally on increasing volume, confirming that demand is now overwhelming the scarce supply. Mark stresses the importance of seeing shakeouts within the base, points where the price briefly dips below a prior low or obvious support level, flushing out weak holders and traders with tight stops. Seeing one or more shakeouts before you buy actually strengthens the setup, as it reduces the number of potential sellers hovering just above your entry point. Look also for signs of strong demand, big up days or weeks on huge volume, especially coming off lows within the base or breaking through resistance levels. Crucially, Mark emphasizes buying strength, specifically buying stocks breaking out to new highs from proper bases within a Stage 2 uptrend. This directly counters the common buy low, sell high mantra, often misinterpreted as buying beaten down stocks at their lows. A stock hitting new highs has no overhead supply, no trapped buyers waiting desperately to sell at break-even, and demonstrates powerful institutional demand. Stocks languishing near 52-week lows lack momentum and face significant resistance from all those trapped holders. He shows compelling examples like Taser, Yahoo, Microsoft, and Monster Beverage, where the real explosive gains began only after the stocks hit new all-time highs. Now, what happens after you buy? Sometimes a breakout squats. It moves above the pivot but closes back near it, or pulls back slightly in the next day or two. Mark advises patience here, giving the stock a reasonable chance to stage a reversal recovery, as long as your initial stop loss isn't triggered. Healthy stocks exhibit what he calls tennis ball action. They pull back briefly, but bounce back quickly to new highs. If a stock breaks out but then violates key moving averages like the 20-day, or shows widening volatility, it's a clear sign of failure. Sometimes a setup simply fails, and you get stopped out. Don't discard the stock immediately from your watch list. If the fundamentals remain strong and intact, watch for a failure reset, where the stock forms a new, often even better, base after the initial failure. Some of Mark's biggest winners were actually stocks that stopped him out first. Stay objective. Assess the new setup purely on its own merits. This entire process demands discipline, but the most critical discipline of all is risk management. Mark devotes 2 full chapters to this, calling it the absolute key to consistent success. You can't control how high a stock will ultimately go, but you can absolutely control how much you lose on any single trade. The cardinal rule: cut your losses short. This sounds like a tired cliché, Mark admits, but it's precisely what separates consistent winners from persistent losers. Losses work against you geometrically. A 50% loss requires a 100% gain just to crawl back to even. A small loss, say 5% to 10%, requires only a slightly larger gain to recover completely. Never let a small mistake mushroom into a devastating blow. Mark shares his powerful loss adjustment exercise. Early in his career, he went back through all his trades and recalculated his performance, assuming he had capped absolutely all losses at 10%. The difference was staggering, turning a losing record into a highly profitable one. This single exercise convinced him that disciplined loss cutting was paramount above almost everything else. How do you know when you're wrong? Simple. The stock goes down below your predetermined stop-loss point. Accept the market's judgment immediately, without argument. Don't hope. Don't rationalize. Don't become what he calls an involuntary investor, holding a losing trade long-term simply because you hate admitting a mistake. Studies consistently show investors tend to hold losers far too long and sell winners far too soon, the well-documented disposition effect. You must consciously reverse this natural tendency. Where should you set your stop-loss? It's not arbitrary or random. It should be a mathematical function of your expected gain. Know your trading statistics intimately. What's your average gain on winning trades? What's your win rate or batting average? Mark aims for at least a 2-to-1 reward-to-risk ratio. Average gain is twice the average loss, and ideally 3-to-1. With a 2-to-1 ratio, you can be right only 1/3 of the time and still break even. With 3-to-1, even a 40% win rate can build a fortune over time. He suggests setting your maximum loss at no more than half your average gain, but never more than 10%, regardless of your average gain. If you need more than a 10% cushion, your timing or stock selection is likely flawed. Never commit the trader's cardinal sin: letting any single loss exceed your average gain. Determine your stop loss before you enter the trade, and write it down physically or digitally. When the price hits it, sell immediately. No hesitation, no second guessing, no waiting to see if it comes back. If a stock gaps down viciously below your stop at the open, sell immediately at the next available price. Don't wait hopefully for it to recover. What if you hit a brutal losing streak? First, assess honestly. Are your selection criteria flawed, or is the broader market environment simply hostile? Leading stocks often break down before the general market turns lower. If you're getting stopped out repeatedly across multiple positions, reduce your position size and overall exposure immediately. Trade smaller amounts, not larger, until your results demonstrably improve. Build confidently on success, subtract quickly on setbacks. And absolutely never, ever average down, buying more shares of a stock as it falls to lower your average cost. This is throwing good money after bad, doubling your risk on a proposition that's already proving you wrong. Only losers average losers. Professionals may scale into winning positions, adding more as the trade works beautifully in their favor, but never add to losers. Mark also advises strongly against over-diversification. Holding too many stocks prevents you from knowing them well, makes it impossible to react quickly, and virtually ensures average results. He suggests concentrating capital in a smaller number of your absolute best ideas, perhaps 4 to 12 stocks depending on portfolio size. Risk doesn't come from concentration. It comes from not knowing what you're doing. Concentration allows intense focus. Finally, he stresses patience above almost everything. Don't feel compelled to trade constantly just to be doing something. Wait patiently for the high-probability setups, those rare moments when the fundamentals, technicals, and overall market tone align beautifully. Trade like the cheetah in the wild. Wait patiently, conserving energy, for the perfect low-risk opportunity, then strike decisively with full force. Good trading should feel almost effortless, even boring at times, not like a constant, stressful battle requiring heroic effort. Mark Minervini's approach is a comprehensive system built carefully on mindset, studying historical precedent, strict criteria for stock selection through SEPA, precise timing using chart patterns, especially the VCP, and ironclad risk management. It's not magic, but a genuine craft learned through immense dedication and unwavering discipline. What Mark Minervini offers us in Trade Like a Stock Market Wizard isn't just another trading system to add to the pile. It's a complete philosophy built on relentless self-improvement, empirical evidence, and perhaps most importantly, deep humility before the market. The recurring theme woven throughout his work is the profound power of discipline, the discipline to study when others relax, the discipline to wait patiently for the right setup when others chase, and the crucial discipline to admit when you're wrong and cut losses immediately. It's genuinely fascinating how he strips away so much of the noise that constantly surrounds investing, the obsession with predicting the market's next move, the reliance on complex valuation metrics like the P/E ratio, the deference to so-called experts or massive institutions. Instead, he brings everything back to observable, verifiable facts. How have the biggest winners actually behaved historically, and is this stock behaving like them right now? His SEPA strategy and focus on Stage 2 uptrends provide a crystal-clear framework for identifying potential, while the VCP pattern offers a concrete, visual tool for timing entries at points of least resistance. But the real genius, the part that truly separates consistent winners from everyone else, lies in his unwavering emphasis on risk management. The idea that you can achieve phenomenal success, even if you're wrong half the time, simply by ensuring your winners are significantly larger than your losers, is genuinely game-changing. It shifts the focus completely from needing to be right all the time, which is impossible, to managing inevitable mistakes effectively. Cutting losses isn't presented as admitting failure, but as a necessary operational cost, exactly like a retailer marking down unsold inventory. For someone just starting out, perhaps like a 17-year-old listener exploring these ideas, these lessons extend far beyond the stock market itself. The importance of dedicated study, of learning actively from failure, of detaching your ego from outcomes, of cultivating patience, and of disciplined execution. These are foundational principles for success in virtually any field. So, what can you actually do today? 1. Start observing. Even if you're not trading yet, start looking at stock charts regularly. Can you identify the different stages Mark talks about? Can you spot areas where volatility contracts? Just observing builds familiarity and trains your eye. 2. Practice the pain. On paper, or with a tiny amount of real money, practice setting a stop-loss before you enter a hypothetical trade. Then, crucially, practice honoring it immediately if it gets hit. Feel that small sting intentionally. It's far better than the agony of a massive loss later. 3. Study success. Just as Mark studied past winners obsessively, look at stocks that have made big moves recently. Go back and analyze their charts and fundamentals before the big move began. What characteristics did they share? What did the VCP look like forming? That was our exploration of Trade Like a Stock Market Wizard by Mark Minervini. We've journeyed through the core ideas today, touching on the mindset, the strategy, and the discipline that fueled his incredible success. But honestly, a summary like this is just scratching the surface, like looking at a detailed map instead of actually exploring the territory yourself. The real understanding, those moments where an idea truly clicks and fundamentally shifts your perspective, often happen quietly while you're turning the pages yourself, letting Mark's stories and detailed examples sink in deeply. This summary is intended to give you a strong sense of whether this book's rigorous approach is what you're looking for. If the ideas of superperformance, disciplined strategy, and rigorous risk control genuinely resonate with you, then picking up a copy isn't just about learning specific techniques, it's about potentially transforming how you approach challenges and opportunities, both in the market and far beyond. You can find a link to the book in the description below. Also, if this journey through Mark Minervini's insights sparked something in you, please show your support by liking this summary and subscribing to the channel. That way, you won't miss our next deep dive into another remarkable book from the billionaire's bookshelf. Let's continue learning and growing together on this path.